Hi everyone. Welcome along to our first session this morning. I'm following the plenary. I am off camera. My internet is a bit dodgy, so I'm not going to turn on my camera and risk this session. It's going to last for an hour from 10 to 11. It's on the topic of inequality and earnings, and it's got 3 papers. The first paper by Ciarán Nugent, second paper by Dr Barra Roantree, and third paper by Professor Frank Walsh. Each of the speakers is going to speak for about 15 minutes, and we would encourage, if you have any questions for any of the speakers, to put them into the Q&A box as we go along, and we will present any questions that anyone has after each speaker. I'm going to give each speaker a 2-minute warning that their time is up. But so as to not delay and eat into people's time, I'll just let Ciarán, who's going to be the first speaker, start.
Thanks, Lisa. Okay, so thanks a million, everybody, for attending. Is that going to work there? Okay, this is a quick presentation on our NERI report that came out last week on some new data from the Structure of Earnings survey, which is collected by the CSO and Eurostat, or collected by the CSO and published by Eurostat, and it's every 4 years, quality data on hourly earnings. This report in particular is on hourly earnings, but they also publish by monthly and annual. But there's a lot of data there, so much so that you wonder where to, where to stop the report. So we see there that not only do you get hourly earnings at different in different parts of the distribution. I see P10 there is a 10%, so the point at which 10% of earners earn less than 90% more. You've got the median, the P90, which is 10% of earners earn more than the 90th percentile, and the mean. And we also get breakdown by various different demographic characteristics and employment characteristics. So age group, gender, occupations, the 9 ISCO codes, managers, professionals, clerical workers, etc. By a NACE sector, but a very wide NACE sector, not the 13 or 14 sectors that you might get in the likes of the EX data, but kind of broad proxies for the private sector, broad proxies for service, manufacturing, and the public sector. The public sector has been it's not exactly the public sector, but anyway, and by full-time, part-time. And you also have the option of converting all of these. Clearly, the estimates would be in the national currency. There are 30 countries in the data set. They also provide data on PPS, which is a hypothetical currency, which tries to incorporate the cost of living using the national consumer price index, and seeing how much these hourly rates will buy in goods and services at the different points in the distribution. They also provide a lot of data on rates of low pay and certain groups, and the rates of low pay within those groups. And the rate of low pay is defined as 2/3 of the median hourly rate. So there are some issues regarding the time series in an Irish context. Absolute estimates to be interpreted with care. There was changes in methodology. But yeah, and so the time series on direct time series on some of these estimates is not really perfect, though. Within the surveys, they should be internally consistent, and ratios like the gender pay gap or the intergenerational pay gap or percentile ratios, there should be no reason why they're not comparable over time. So that's just a graphic for those who aren't dealing with this kind of stuff every day, just to get a feel for what it means. It gets a bit dry, the sentences get a bit long at times when you're describing this data, but that's basically what the 90th percentile is. This point, and this is from the Bureau of Labor Statistics, excuse me, there's no U there, but it's the US spelling there. 90% make less, 10% make more, and that's the median. So and this is the 10 percentile. So it's these three in particular that the SES data provides, and these three that I'll be focused on for the most part, although I talk averages as well, which is usually located somewhere around here due to the skewed nature of the earnings distribution. So it'll be generally higher than the mean across the board, or than the median across the board, excuse me. So this is just a graphic, and it was actually, I think it was just up there in Morgan's presentation there, and it's just to get a feel again for what we're talking about here. Obviously we're at the 90th percentile, but I'm just keen, and I'll use the term the top and the bottom interchangeably with 90 percentile and 10 percentile just for brevity. But it's important to note that it's not really the top and it's not really the bottom. That the gap between the 90 percentile and the 99th in weekly earnings is actually about the same as the gap between the median and the 90th in relative terms, somewhere in the region of 2.5 times. So that's just to note while we're looking at these when I'm talking top and bottom. So I've just chosen a few of the tables. There's a lot of tables in it. In the report, there's about 40. So this is table 3, and you can control for full time, which is often preferable, or at least it's good to see, along with the estimates that incorporate the entire employee sample. So what we're looking at here, what's of interest here for us is the P90 over P10 ratio, which is basically the gap between the top and the bottom, right? These are full-time workers. This is Euro. These are what we call high-income EU countries, over 25,000 a year per capita GDP, excluding Luxembourg. The UK, we're still in the EU, of course, in 2018 as well. And so what we see here is actually Ireland's a bit of an outlier in terms of that gap between the top and the bottom. The next most unequal country in this respect is the UK, followed by Germany, and there's quite a big gap there. There's about a half of an hourly wage of the worker at the P10. And even when you look at the 30 samples, there's only really one country, the 30 countries in the sample, there's only really one country that stands out as particularly more unequal than Ireland, and that's Cyprus. So Ireland comes in around 5 or 6 in 30, and the rest, I think, is Bulgaria, Romania, Poland, I think, are above them, but they're not really that far above them. They're about less than 4.1. Every one of them except for Cyprus. So we are quite on an unequal distribution there in those terms. So this hypothetical PPS currency, although it's not the focus of the report, I just thought it's very interesting. I trim a few tables there on this data, and it basically shows, after showing that a wide gap in the P90 over P10 ratio, it shows that actually, once you consider the cost of living, that Irish earners in this high income European context, Irish earners at the bottom can buy least amount of goods and services out of all of these, and Irish earners at the top can earn close to the top, just slightly under Germany. I think in the actual Without the full-time, it's the opposite. We're not including part-time and full-time workers, not the opposite, including full-time and part-time workers. Irish earners at the top can buy most, but I think it's pretty striking there that Irish earners at the bottom can buy least goods and services with their hourly earnings at that point in the distribution. So moving on, it stays pretty much the same. The Netherlands come in just above us in the business economy, which is a broad but imperfect proxy for the private sector. The Netherlands, what's pushing that there, and I saw in some of the age group stuff, is that they have a big chunk of workers on very low wages, apprenticeships, etc. So if you look at the under 30s P10, it's around €4. So that's kind of pushing that gap there. But you see again Ireland in the high earners in Ireland in the high brackets here. Only Denmark is higher in euros out of the 10 country sample. So this is the performance over time. We've bounced around slightly, but we're pretty much the same. We're slightly better in 2018 than in 2006 with this gap. But other countries have actually improved, like the UK and Germany at the same time. So we've got similarly the gap between the middle and the top has grown in Ireland, and it's again an outlier. Well, maybe not an outlier as much as in the last one, but it's certainly the highest, and it's well ahead of Germany and more similar to the UK. But again, the highest gap between the median and the top. And then the median and the bottom, the gap between the bottom and the middle has come down in Ireland over those couple of years, but not by much, and is still among the highest. We see there the Netherlands has slightly higher, and Germany has a slightly higher, bigger gap between earners at the bottom and earners at the median. So what's driving this? The report also looks at within occupation inequality to see if this might be an issue to explain the high level of inequality in the Irish wage structure. And we see in a lot of in most of these occupations we stand out. Italy there is an outlier there, and it's actually quite ahead of us in terms of the gap between managers at the bottom and managers towards the top. But we're well ahead, and even twice the gap in places like Sweden, twice the gap is in Belgium. Within this occupational group. One of the main occupations pushing this, and because it's such a large share of Irish employment, it's in around 1 in 4 Irish employees are in this professional group, which includes IT, workers in finance, workers in law, a lot of medicine, teachers, etc. At the high end, our professionals are paid the best in Europe. Even I might be corrected here, but it's very similar, and I think just tipping even Luxembourg, which I thought was very interesting. So you can see here.
We've just got 2 minutes left, Ciarán.
Thank you, Lisa. A clear outlier in terms of the gap within the group of professionals. 3.62, a difference of 3.6 times the earnings at the P90 relative to the P10 position in the earnings structure. So what I did then, I looked at some of the ratios for under 30s relative to the average and how that might have developed over time to see if this is, you know, of any interest to anyone. And I do a lot of work on labour market for younger people and precarious work, etc. So this was a particular interest to myself and to Nevin. So we see there that the ratio of average earnings for under 30s hourly compares to the average of the entire economy is among the lowest in Ireland. So it's lower in the Netherlands. I talked about some of that apprenticeship stuff there that I think has the Netherlands as an outlier, but it's quite low and it's fallen more in Ireland than anyone else except for Belgium. Belgium had a similar fall, but the intergenerational inequality is not as high in 2018 as it is in Ireland. And if you control for full time, then that actually becomes more stark for Irish workers under 30. And the drop in that time period has been more for Irish workers under 30. So this full time will include, you know, graduates, of course. So we can't really say, you know, there's more in college and they're working part time or whatever. So Belgium saw a similar fall, but not by as much and not to as much a low level. And then once you control for that full time, we're down equal to the Netherlands at joint bottom place. And you see this applies as well across the board to occupational structures, which I did all 9 of and which are available in that report. And you see there that the manager under 30 only gets 50% of the average manager in Ireland, compared to over 60% 12 years previous. Same for professionals, and among the lowest there again, among the lowest ratios, and even among the low skilled, lowest full time occupations, it's fallen by about nine points in that time, which I also found. So it's across the board. I think maybe the only exception was skilled agricultural workers, and there's issues with the data there as well in that particular group. So basically the report finds that almost any way you look at it, not almost any way you look at it, but in lots of respects, the structure of Irish earnings has become more unequal, is among the most unequal in Europe, and for younger workers has become less well paid relative to the rest of society, relative to the rest of the labour market over the years that included the financial crisis and the recession and austerity. So this is just quickly, I'll just run through that. We have a high rate of low wage earners. It's actually higher in the OECD data, and we're actually higher than Germany in the OECD data. So there's slightly different definitions there. But low wage earners under 30, again, a high, not as high as the Netherlands, but among the highest, not as high as Belgium. We are an outlier, and I'm doing some work on this stuff at the moment.
I have to stop you, Ciarán.
Yeah, well, people with tertiary education, last slide there, we're an outlier in terms of those with a university education who are low wage earners. So that's it. Thanks a million, and I'll leave it over to you, Lisa. Cheers.
Okay. Sorry, we're just so tight on time.
Yeah.
We are just one question just to follow up before we have to move quickly on, is about the policy issue then. Is the policy issue about the extremely high earnings of our professionals and our managerial classes, or is it about the glut of low paid workers we have, or what combination of that mix?
Yeah, I suppose it's both. I mean, as I said, when you look at the actual euro the euro equivalents, the professionals at the high end and at the average earn quite a lot, and that's in particular the case for you can control for older workers there as well, and you look at the rankings there, and Irish professionals over certain age groups are ranking first or second in the European context, and then when you look at professionals on average under 30, they might fall down the rankings. So that's probably pushing it more. And the share of low wage employees as well. So the one of the points I make there is just in the in the memorandum of understanding, there was there was some issues that weren't tackled there in terms of high cost of law, which undermine competitiveness for all Irish business because it makes legal services more expensive. That was never really tackled. Although now you can't identify with this data who exactly is in that top 10%, but so that's a working theory. But it's a combination of both. It's a low, a high share of low wage earners, and a high share of high earners as well.
Yeah. Okay, I'm going to leave it there, and I'm going to move on and ask Barra to come in and with his presentation on earnings inequality, and then earnings growth story and inequality in Ireland over the 30-year period, 87 to 2017. So thank you very much, Barra.
Great, thank you, Lisa. Can you see that there okay now?
I can, yeah.
Brilliant, yeah, okay, sorry, my monitor decided to jump around. I'm very much looking forward to the end of screen sharing and getting back to some form of normality in terms of presentations. But what I'm going to present to you today is just a few extracts for some work in progress with my colleague at the ESRI, Paul Redmond. And what we're really doing in this is we're building on some work that I had done and published earlier this year, drawing on various survey data over the period 87 to, well, actually 2019, and that, looking at how incomes have evolved. And what then really doing in this paper is just kind of drawing on some of the data we've built through that over time to look at earnings. And so what I'm going to do is just pull out a few kind of key facts. So that it's just going to be some descriptives I'm going to show you. Again, this is very much work in progress, so keen to get people's views and thoughts. Even if you don't get a chance to ask a comment or a question in the during the session, please do email me or Paul about this. If there's something that you think would be interesting for us to look at, or you think might be interesting to go in a certain direction, I'd be very keen to get your views. But essentially, the kind of question we're interested in asking is how have earnings evolved in Ireland over the last 30 years? And what we're drawing on is some pooled survey data that we've kind of spent quite a lot of time trying to harmonise and get relatively tight definitions across various different surveys. So there's the 1987 ESRI survey of income distribution, poverty and usage of state services. This was a survey carried out by the ESRI back in 87. There was then the ESRI carried out the Living in Ireland survey between 1994 and 2001. I'm just going to use the data up until they added a booster sample, because I'm not quite sure about the weighting subsequent to that in 2000 and 2001. And then follow up that by using the survey of incomes and living conditions from 2004, that should say, sorry, not to 2017. So I'm using the UDB version of that data that's provided through Eurostat, but gives very similar answers using the RMF version, which gives an extra year at the start and extra 2 years later on, but requires you to work on the virtual desktop environment of the CSO, and just so it's running a bit close for time, so use the UDB instead for this. So what we're building on, I think, a rich literature examining changes in earnings in Ireland, but mostly over a shorter run. So many of the papers that are cited there, most of them seem to have been published in the Economic and Social Review, but many of them used the data that I've described above, but or a combination of that data, but over a shorter period. So there's some of those papers examine how earnings changed between 87, say, and the mid-90s, some between the mid-90s and the early 2000s. But there isn't really kind of something putting these all together. So that's kind of the goal of this paper, was to try to get a long-run series, or at least a long-run series in modern history of earnings. One paper there, Atkinson and Nolan, in the Economic History Journal, looks at the evolution of earnings in Ireland from like the 30s through to the late 60s. So that's a slightly longer period than looking at here, I think, but an earlier one as well. But this is really kind of the aim to try put together something so we can say something about how earnings have evolved over kind of the 90s, 2000s, and 2010s in Ireland. And here's just the first graph from that series. So this is just simply average real weekly earnings. I'm indexing them back at their 1987 level, and here they're adjusted for inflation by the CPI, and I'm showing you the mean and the median for individual earnings over that time. And so what you can essentially see is that there was quite strong growth over the late 80s and 90s. It slowed down a bit then over those late 90s. Growth over the 2000s kind of really picked up in the mid to late 2000s. And then part of this, then we see earnings kind of peak at around 2010. And part of that, I suppose, is selection in who was losing their jobs early on in 2009, 2008. Maybe some of the lower paid workers there that kind of skewed up, because we see that incomes actually fall over that time. Then we get a bit of a fall in incomes. And we've got a bit of a recovery then so far. It's not actually as strong as what you'll see in incomes. And again, that's kind of something that I want to highlight in this paper really, and is that the growth that we've seen in average real weekly earnings isn't near as net incomes, and that is after tax and benefit. And that's what I'm showing you here. So again, just indexing these back at their 1987 level, what we can see is that disposable incomes adjusted for household size and also inflation grew by far more over the same time period. And you can see that kind of divergence starts to really open up in the late 90s and then 2000s. And so this is something that, and as well, even you can see that the recovery as well has been much stronger in terms of disposable incomes than it has in terms of average earnings. And really, I suppose, that's something I want to kind of dig into a bit more. But I think what it does suggest is that changes in employment rates and participation within households is, and also then changes to the tax and welfare system are as important, if not more so, than changes in earnings in terms of understanding the growth in net incomes that we've seen over the last kind of 30 years in Ireland. So that's just something I thought was kind of interesting, just how much slower earnings growth has been than incomes growth, and something I think that's worth kind of bearing in mind when we're talking about policies to address inequality and deprivation and poverty and the like. That it, earnings aren't the whole story. They're or haven't over the last 30 years. They've been a smaller part of that. So another thing kind of stands out just in terms of simple descriptives is if we look over this period, growth has been a lot faster in earnings for women than for men. So here again, I'm just plotting the median and the mean. For men, they're shown in blue or turquoise. And you can see that, again, that's kind of not far off the average. Kind of it goes up by about 50% in real terms after inflation over between kind of 87 and 2007-ish. Falls down a bit and then a bit of a recovery, although kind of maybe flatter for men than for the total. Whereas for women, we see that, again, kind of tracks similarly in the earlier years, but really it's over 2000s and then even in the recovery that those average earnings have really increased by more for women than for men. So that again was just quite a striking thing. The natural implication of that is that the earnings gap, not the hourly wage gap, but the earnings gap that would suggest it's kind of fallen over this time, at least on average and at the median. So again, this was quite interesting. And what's additionally we thought was quite interesting about this these patterns of growth that we see is that growth for women was actually faster at the bottom of the distribution than the top. So what I'm showing you here is how earnings have changed across the distribution between 87 and 2017. And what I'm doing is lining up individuals, splitting them by sex, men and women. I line them up from left to right according to lowest to highest earnings in both those years. And then what I'm just plotting is the growth in earnings for men. So these are kind of sex-specific centiles of the distribution. And I'm then plotting just the change in earnings, again, indexed back to 100 being their 87 levels. And what you can see for men here is that the change in real weekly earnings for men was relatively kind of flat across the distribution, maybe a little bit lower in the kind of bottom half, or really in the bottom middle, I suppose, of the distribution than at the very top. But down here as well, it's kind of not far off that. So it's relatively flat earnings growth for men across the distribution. But whereas what you see for women is far stronger growth at the bottom. So we see really for the bottom third of women, at the bottom third of the distribution for women, I should say, we've seen earnings grow by, I suppose this would be 200%, 300 minus the 100. So relative to their they've increased really significantly at the bottom of the distribution, much more so than higher up the distribution. And so that's just something that was, again, quite striking about changing the earnings distribution over time, and something I think we want to kind of dig into it more. So here again, we're talking about weekly earnings. And so, as I'll come back to at the end, there's a question of, well, is this hours or hourly wages that are driving that? And that's something we want to kind of maybe dig a bit more into in this. Another interesting thing I think that pops out from looking at these data is actually that much of the growth is driven by rising education levels. So what I'm showing you here is, again, indexing earnings back at their level in 1987 at 100, and showing you how they evolve over time. But here I'm splitting it for, so I've got the all lines, so this is the grey line, is the one you will have already seen, and then I've got it by education level. And what's kind of interesting here is that once you condition on education, the growth has actually been a lot less impressive, right? So what you see is, like, even over the 90s there was, and you might maybe worry a little bit about some of the smaller sample sizes here, particularly the tertiary group, which wasn't maybe particularly large at this time. But we know that group is becoming larger over time, and that really seems to be one of the things that's driving this increase in overall earnings, right? In that we see that there's this rise, the tertiary, conditional on having tertiary level education, growth hasn't been as fast as for all. And so, the implication of this, and what you do see, is that, a lot of the growth in average earnings has been because people are becoming more educated, and because of this relationship between education and earnings. Now, obviously, there's kind of selection going on to that, and so part of this is, if more, the people who would have maybe had higher secondary moving into tertiary, maybe that changes the composition of that group who have just the higher secondary education. But it is quite interesting that what this suggests is that a lot of the growth that is really kind of being driven by that switch into that increasing educational attainment levels. It's not the only thing that's going on. So we do see, as I'm showing here, that there's been a rise in the tertiary education premium. That is, so if we look at the ratio of median tertiary weekly earnings to median upper secondary earnings, we see there's been kind of a bit of a rise over that, particularly over the mid to late 2000s. So this is again something that we're going to want to dig into a bit more, and have been trying to do some decompositions and look at these things a bit more detail. But it is quite interesting to note that that the composition of the Irish labour force changing seems to be a particularly important aspect in explaining some of the changes that we've seen here. Something Ciarán mentioned earlier on, this is just a figure actually that I've reproduced, and that was published in a report out earlier this year. But what I'm showing you here is average real weekly earnings in 2019 prices, so in 2019 euros, showing it by age for different birth cohorts. So, for example, this kind of brownish line at the top is the average earnings for people born in the 1940s over the ages kind of 45 to 55. For, again, the orange line kind of for 1950s over that age, and so on. And the really interesting thing kind of to take away from this graph, or the thing that I find striking, is that for most of these cohorts, each younger cohort, so the 1950s lies above the 1940s. Similarly, the 1960s, with a bit of kind of noise really kind of here, lies above the 1950s line, and similarly 1970s above the 1960s line, right, all the way, right. And what this is really kind of highlighting is what I think is entirely normal, what you'd expect to see over time when you're experiencing real growth, is that each generation has higher earnings adjusted for inflation at the same age than the previous one. However, that's not so much the case for those born in the 1980s and 1990s. So if we take the 1980s first, that's kind of the green line, we see that they started off actually with earnings above people born in the 1970s. However, by the time they got to around age 25, we had the effects of the Great Recession kicking in, and that really led to stagnation in wages, to such an extent that actually by their early 30s they earned less on average than people born in the 1970s. Now, by age kind of 35, in the latest year of the data here, we're kind of starting to tick back up again. But remember that this period, around age 35 for people born in the 1970s, is also affected by the Great Recession and the financial crisis and the time after that. So that's a very low bar to be kind of surpassing. If we look at the 1990s cohort, we see that actually they started off their careers with average earnings no more than those born in the 1960s, and they have never really had earnings higher than people born in the 1970s. And again, we see it was kind of just about catching up there by age 25, but it really hadn't surpassed it. And so this kind of stagnation of earnings growth for younger adults is something that we kind of highlighted earlier in the year, some report, but is again something kind of interested in digging more into, because it's not a phenomenon we see just in Ireland. from evidence from the UK that you kind of see a similar thing. And what in particular is notable there is that you see younger adults starting lower down the wage distribution than their kind of predecessors at the same age, and also starting off in kind of occupations that are less well paid. So we see that they start off more in occupations like in hospitality, retail, and then as a result potentially of that is that the earnings growth is less quick over their kind of early years, so that's kind of something which is quite potentially a big change in the labour market, and something that we're kind of interested in understanding more of. Again, I just kind of wanted to highlight this as being one of the things that comes out of I suppose this longer run series, and look at how earnings have evolved, and how earnings are evolving for younger adults entering the labour market. It looks to be an important feature that kind of we're interested. I'm sure others are interested in kind of understanding more.
Just have 2 minutes left, Barra.
Perfect. It should just finish up in time then. So I've kind of shown you kind of a few kind of broad trends that are kind of that stood out to us and that we're interested in exploring further. But just look at the overall impact on earnings inequalities. We can look mostly at growth for now, but the combined effect of these kind of different features and others that I haven't mentioned is that there's been a rise in overall earnings inequality on kind of most summary measures. So Ciarán showed you some stuff. You're looking at both 90-10 ratios with a different data set. Here, this is kind of meant to be representative of the entire population, and it's weighted to try to be so. And if you look at the earnings, then summary measures of this, you see kind of over a longer horizon, you see that also overall earnings inequality is increasing. So this is the Gini coefficient plotted here. So that number that goes between 0 with perfect equality and 1 with perfect inequality. And we're seeing kind of a little bit of a dip maybe over the 90s, but then really it's been rising over the longer run period. We can use other summary measures of inequality, and we see kind of the same thing. There's been an increase, particularly over those later years of 2000s, and that maybe again there has been a start to be all of these are then dipping down from 2015 or so, and so hopefully that's a trend that will be recovered. Although again we now have the pandemic appearing here in 2020 when we get data for that. And again, just kind of come back almost to where I started off with. I think the interesting thing here is that we have essentially rising earnings inequality amongst those in work at the same time as falling disposable income inequality. And I think that's just an interesting thing, to highlight, and something again that we're interested in understanding more, because these things aren't, you don't have to have rising earnings inequality to have rising disposable income inequality. These two things can go in different ways. They're different concepts, and really, I suppose we're going to be doing work in the coming months and probably years to try and understand the difference, what's driving the difference between these two things and the implications that has for policy. So this is really just something I kind of wanted to highlight, that disposable income growth has really been much stronger, as I showed you at the start, than earnings growth, but also the evolution in terms of equality trends have been quite different, and that's just something I want to kind of highlight and say that we'll be trying to do more to look at. So next steps through your research, I've already kind of preempted a bit of this. So we want to look a bit more into how much of the growth is the result of rising educational attainment, and so also look at how that varies across the distribution of earnings. Done some initial decompositions to suggest that it is a little bit different at the bottom and the top. That at the bottom, composition changes seem to be more important, and at the top, changes in returns to education. And what's driving differences in earnings growth by sex? I've only really talked in what I've shown you about weekly earnings. Obviously, very particularly for women, what will be quite interesting to see is whether that's because of an increase in hours worked, or is it an increase in hourly wages. And also, is it down to changes in occupational sorting? What type of occupations that women tend to go into compared to men? Is that what's changed, or is it something else? Is it kind of within occupation that we've seen a change in how things are paid, or how many hours are worked? So that's kind of something we want to do more is there. Also, as I said, very keen to get people's thoughts. You can throw it up in the comment box if you'd like, and I'll see that. Or please do email myself and/or Paul to suggest something that you thought might be of particular interest to look at. So thanks very much for coming along, and again, hope this is one of the last virtual presentations that we hopefully have to do before we're going to get back to things more in person.
Brilliant, Barra. I've got a few questions I'm just going to put to you that have come through the Q&A function. The first is related to that last point that you made about whether or not this is to do with composition. And the question is, those born in the 90s had lower earnings in their early 20s than those born in the 60s. Could that not just be because they're studying, whereas people born in the 60s were working full time in their early 20s?
Yeah, so we see the same thing in terms of hourly wages. Essentially, it's not quite as pronounced, but it's still, we see the same thing of that you're getting that stagnation in hourly wages. In addition, you're still seeing those patterns by kind of the mid to late 20s, by which time full-time education is completed for the vast majority of people. Not those of us who, I suppose, try to escape the real world for as long as possible and do further studying PhDs and the like. But for the vast majority of people, by your mid to late 20s, your education has, you might do stuff into the future, but you're not in kind of full-time education at that stage. So I know we've looked into that. Don't think it's just a compositional effect on that. And again, this isn't an effect just in taking place in Ireland. This is something that we're seeing in multiple countries, that those entering the labour force are doing so lower down the distribution when they kind of come into it. And a full-time worker, they're coming into it in occupations that aren't as well paid, and they're coming into it in occupations that don't deliver the earnings growth in those initial years. And those two things kind of compound. If you're coming down, if you're entering lower down the kind of, the wage ladder, if you want to think of it like that, growth becomes more important for your future prospects. But yet we're also seeing slower growth. That's some research that's been done by Richard Blundell and others at the IFS and UCL. So again, I think this is a really potentially important development in the labour market in not just Ireland, but in other countries, and something that should be of interest in trying to understand that. But no, it's not just a compositional thing, in short.
Yeah. Have you thought, or have you looked about so the skills bias, so kind of the theory of skills bias technological change kind of sitting there within the automation literature, I suppose, being talked about. Have you thought about the extent to which skills bias, or have you looked at cross-country comparison? Is there a much greater skills bias in Ireland as compared to other countries? The returns to education, or the returns to having skills being greater here?
Yeah, so that's something I think that we can look into. One thing that kind of strikes me kind of initially from that is that, a lot of that skill bias technological change literature emphasizes, I suppose, people who are, there's almost an industrial sector where education wasn't as important, and that kind of, technological change leaves that redundant and goes in other ways. And so in a way, we kind of avoided that by not really industrializing at the same time as maybe lots of European countries having that convergence growth over the 20th century. But I think also an interesting thing here is in relation to kind of a related feature that was, I suppose, discussed a lot at the same time as a lot of that skill bias technological change literature, which is in terms of the essentially supply and demand of higher educated people. We saw huge increases, like one of the fastest in Europe in terms of higher educated, in tertiary educated individuals, and they became, also because of demographics, a much larger share of the population. And so I think there's an interesting question there to look at, well, to what extent, with the numbers of those coming on, did the returns to education hold up in Ireland? Or if they did hold up, that's kind of, might be particularly remarkable. I know they did in many other countries, but that's something I want to look into a bit more, particularly given that just descriptive graph on, earnings for tertiary education people being relatively flat over the longer run, which suggests that maybe the returns haven't been boosted by as much as we might have thought.
Yeah. The reason I was interested in that is when I done the gender pay gap comparative stuff in the North and South Ireland, the returns to education are much greater in the Republic than they are in Northern Ireland, despite greater proportions of the population having tertiary education. But we'll leave it there. Sorry, I'm going to have to move on to Frank.
Yeah, perfect.
And thanks very much, Barra, for an interesting presentation. So Frank, if you're ready, we'll get going.
Okay, thanks. So just do the screen share. Okay, so hopefully you can see the slides there. So I'm going to talk about non-compliance in the Irish National Minimum Wage. So basically, I know if anyone was on earlier on with the CSO, Morgan O'Donnell talked about this new data, the LFS EAADS. So basically, there's data that's become available in the last year or so, which gives us administrative data on earnings and matches this with some variables from the labour force survey. And given this, I thought it would be useful I'm a member of the Low Pay Commission, but this is just my own work. It's not the Commission's work or anything. I thought it'd be interesting to see what the measure of non-compliance with the minimum wage was with this new data, and it turns out it's much higher than what we're getting from other measures. So there has been recent work in non-compliance which found very low rates of non-compliance with the minimum wage using labour force survey data, and I'm finding much higher measures. Just to give you a quick background, the minimum wage, the national minimum wage was brought into Ireland in 2000. That it was £4.40 at the time, or €5.58, and this is the evolution over time. One thing that is worth noting here is the data I use goes from 2011 to 2018. There is this one kind of anomaly that in 2011, in the middle of the financial crisis, the Troika at the time basically told us to reduce our minimum wage, and it was reduced from January to July in 2011. It was reduced by €1. Now, most companies didn't reduce all the indications are that most companies didn't reduce their wages at the time, but some companies did. So technically, between January and July, you were compliant if you paid €1 less than 8.65. So I left 7.65 in there but maybe later on I'll try it just excluding 2011. But when you see the big, much lower non-compliance in 2011, this is why. Sub-minimum wage rates, basically there's an adult minimum wage rate, which is what the table I just showed you gave. The sub-minimum wage rates at the time that the data covers up to 2018, there were several reasons why you could pay less than the minimum wage. You could pay people less than the minimum wage, I'll tell you by how much in a second, if they're under 18 years of age, or else if they were over 18 and they're in the first couple of years of their first job, and their first couple of years of experience, you could pay them, first 3 years of experience, you could pay them less than the minimum wage, or else if they were in a training program. There are also small allowances, very small allowances for board and accommodation that you can pay a little bit less if you're providing board to your workers. Apprentices and close relatives, if you're working for your father or your uncle or your grandfather, stuff like that, you can be excluded from the minimum wage, and apprentices also. So I'll tell you in a few minutes how I try to deal with that as best I can. Here are the rates. So you see that these are substantially less than the minimum wage. If you're under 18, for example, it's 70% less than the minimum wage. I'll just mention quickly that the system at the moment in the last year or two has been simplified in that the training rates have been abolished and the experience rates have been abolished. So basically, we just have age rates now that increase from 70% if you're under 18 to 80 and 90% for subsequent years, and then 100% over 20. But anyways, this is the regime that existed at the time that the data covers. We had these training rates. So Seamus McGuinness and Paul Redmond and Judith Delaney have a very good study. It was actually a study that was initiated by work for the Low Pay Commission, in which they subsequently published in a journal. And basically, the Labour Force Survey just has a question which asks people, are you paid less than $8.65 or $9.55 or whatever the minimum wage in the year at the time is, and you're asked, are you paid more than this or less than this? And then if you're paid less than the full adult rate of the minimum wage per hour, you're asked why. And you're given a list of options, which is basically, are you under 18? Are you on the training rate, or are you on the experience rate? And then there's an other category. So basically what Seamus and Paul and Judith did was to measure the people in the other category, the people who weren't on sub-minimum wage rates. Now, I can't do this because I don't have this question. The Labour Force Survey questions aren't in the data I have. I have some questions from the Labour Force Survey, but not all of them, unfortunately. So I don't have this question. So I just have very good earnings data, very good data on weeks worked, but no, not this direct question on minimum wage, on the minimum wage. So here is some of the reasons that just a description of the data maybe. So some observations were dropped if they were earned very little, if the duration of employment less than 2 weeks, a very short term, if earnings are really high if reference numbers are missing, and so on, and some small sectors. And it's only for the main job that earnings are gathered. So when I'm looking at earnings here, it's only earnings for the main job. And we're looking at basically tax data. So if a worker isn't paying tax or isn't registered, they're not going to show up here. So my guess is that that's kind of understating non-compliance, if anything. So if anyone is in a, just being paid under the table or whatever, that won't show up. Now, by the same token, if somebody's getting a certain amount of income which is taxed and they're getting additional payments which are being given in the black economy or whatever, that's not going to show up. So if you're getting, half your wages being taxed and half of it untaxed, that wouldn't show up. There are loads of observations in each year. It's a big sample, so there's no worry about that. One feature of the data that is unattractive is that it deletes missing values for all observations. So if you don't answer any question of all the questions in the survey, you're deleted. That observation is dropped. So we don't have any missing values for any variables in this data. Anyone who has a missing value for any variable is just dropped from the sample. So that could lead to non-randomness in the people who are dropped. Unfortunately, we can't do anything about that. The way I deal with the issue of the sample being of the sub-minimum wage rates, people under 18 and so on, is I just look at people over 20. So I kind of hope that people in the first year of their job are mostly people under 20, people under 18 are obviously under 20, and similarly with the training rates. The training rates were very small anyways, according to the Labour Force survey. The number of people on training rates and so on is very small. It's part of the reason they were abolished. I'll move ahead anyways, just so basically, the way I measured non-compliance, I've got this funny formula that probably overcomplicates it because I think it's mostly an hourly wage that the error is, any error. But basically what I do is that a compliant worker is anyone who's either 5% above the minimum wage or 5% below the minimum wage if epsilon is 5%, or else I do it for 10% above or below the minimum wage as well, is counted as being compliant. Non-compliant is basically somebody who's 10%, who's more than 5% less than the minimum wage, is counted as being non-compliant, and I do it for less than 10% as well. So that's what non-compliant with. I allow for a certain margin of error. Hours worked is measured with error, so we have to allow for that. So sorry for rushing through all this stuff, but I think the slides will be up later on, but we only have a few minutes for the talk. So here are the rates of compliance rather with the minimum wage. I've got the numbers from Seamus and Paul and Judith's one here. This is the number of people at the minimum wage here. So you see that when we allow for error of 10%, we're getting much higher rates of compliance. When we do it at 5%, it's a bit lower. But remember that we're only counting people who are over 20, which would lower compliance if anything. So I'm guessing that somewhere around the 5%. So basically, I think that if we allow for an error of 10%, we're probably understating non-compliance with the minimum wage. So somewhere between the 5 and 10% is my guess. Okay, so here's the rates of non-compliance. So the rates of non-compliance that Judith and Paul and Seamus found were less than 1% of the number of employees, which is very low by international standards. The US and the UK, it's kind of 2-3% of employees being non-compliant. Here we're getting higher rates. So if we take the rates of non-compliance when we allow for in our 5% in our measured hourly earnings, it seems to be increasing over time. Now it's low in 2011, but remember that this is the year that we had the 765, the temporary reduction in the minimum wage. But if we take from 2012 onwards, it seems to be increasing over time, and it's certainly much higher rates using the 5% rate. Using the 10% rates even, it's at much higher rates and increasing over time. So we've got 6% in 2018, over 6% of workers non-compliant with the minimum wage, which is 6%. Non-compliant workers represent 6% of employment. which is substantial. It's worth noting, I should have said quickly, that compliance is also increasing over time by this measure up to 2018. So compliance with the minimum wage and non-compliance are both increasing together. When we look at when we break it down, we've very good data on public sector status using this data. So I concentrate on the private sector. Public sector non-compliance is very low, as you might imagine, and semi-state non-compliance is very low. It's much higher in the private sector. So over the entire sample, we get much higher rates than in the private sector, no matter what the error rate is. So I stick with the private sector from now on. Across different age groups, there are striking differences that we see that the youngest workers and the oldest workers are the ones with the highest rates of non-compliance. So even allowing for the 10% error, not too far off, 1 in 5 workers between 21 and 24 are non-compliant, and it's much lower and then it's high for over 65s as well. When we look at migration, it's not really the main thing. Irish workers are a bit less. There's lower non-compliance for Irish workers relative to others, but the difference isn't enormous. It's certainly not the main driver of non-compliance, it seems like. And the other countries is the highest rate of non-compliance. So basically, people from countries further away seem to be there seems to be more non-compliance. I'll just look at a picture of the wage distribution. So this is the minimum wage over hours worked. And this is just a picture of the entire distribution. So you see here that the people to the right of this red bar are basically the non-compliant workers. This is private sector, and this is for all. And we see here that we see the gap between the private sector and public sector. So we see that, as we saw before, the private sector earnings are lower than public sector earnings, and non-compliance is higher in the private sector. What I'm going to do is, just so you see where the picture comes from, I'm going to take a snapshot of between 1 and 2 in this graph, just like taking a close-up of this graph for different groups. This is between 2011 and 2014. You see the 2011 one here. We see the 2011 one is up here, and this is much lower non-compliance, basically up here when this is equal to 1. So this is around 1.5. This is where the minimum wage is equal to the hourly wage, and then anything above this is non-compliance. So you see here that at about 1.5, this is the share of workers, for example. So 98% of workers have a value for this less than 1.5. So that means there's about 2% of workers who are being paid less than 2/3 of the minimum wage, which I think is kind of interesting. So it's fairly stable over this period. It does seem to be increasing. The lowest line here is 2018. So it looks like non-compliance was increasing over time. We see that again, this striking number that about 2% of workers are getting less than 2/3 of the minimum wage, and there seems to be about 1% of workers who are getting much less than that of the minimum wage.
It's gone out. 2 minutes left, Frank.
Okay, so given the time thing, this is just the last picture I'll show you, is the age thing. So again, you see that these are the young workers. So you see that for workers between 21 and 24, these guys here, that they're getting substantially less than minimum wage. And the older workers are here. So there's this gap right away across the distribution, and we have substantial groups of these workers getting paid a good bit less than the minimum wage, I suppose you'd say. So just to finish, I also ran some regressions to look at the probability. Now I just don't have time to go through all the regressions. But I'll write up the paper and so on. But just to tell you some of the things I found that might be interesting. In addition to that, I threw in loads and loads of characteristics, job and worker characteristics into the thing. So some of the kind of main things I described to you in the tabulations showed up in the regression. So just some of the additional things are that workers working very much longer hours and longer weeks work tend to be more likely to be non-compliant. Now, hopefully that's not because of the measurement error in hours. There shouldn't be measurement error in weeks worked. It's from PRSI data. Males are more likely to be non-compliant. It's increasing over time in the regression. That shows up in the regression. Nationality still doesn't seem to matter that much. There are regional effects and so on. So just basically, this is a very simple exercise. I just want to show you that using this data, we seem to be getting that non-compliance, according to this data, even when we look at workers over 20, even when we allow for substantial measurement error in the data, there still seems to be a big chunk of workers who have taxable earnings. This is earnings that are measured through their tax returns that are substantially less than the minimum wage, given the number of weeks worked and given the reported hourly earnings. The rates of non-compliance seem to be increasing over time. So just in terms of the last point, I suppose that there is the prospect of a living wage. It's in the program for government, and that may come to pass, and it may lead to a substantial increase in the minimum wage. So maybe this is just a pointer that one implication is that what we saw in this data was that both compliance and non-compliance seemed to increase when the minimum wage increased. So when there's a big hike in the minimum wage, that both compliance and non-compliance increase. So the people at the bottom are being left behind, but the higher earners are being captured in the minimum wage. And that might be something to watch out if we're going to increase the minimum wage to the living wage. But I leave it there. Thanks very much.
Thanks, million, Frank. Interesting that you said about the possibility of increasing the non-compliance. This issue came up in our discussions with the UK Low Pay Commission. I'm based in our Belfast office, so we would tend to meet them on an annual basis as well. We found that with the substantial rise in what they call the national living wage back in 2016, that didn't actually lead to any increase in non-compliance. So it's really interesting. The extent of non-compliance. I've got a question from Michelle Sullivan, who just had missed in the methodology a bit whether or not non-compliance meant just solely with the full adult rate, or does it include people who are legally entitled to sub-rates as well?
Well, I have no way of distinguishing between the sub-rates. So what I did was I only looked at workers who were over 20. So I hope that will eliminate most of the people who would be entitled to sub-minimum wage rates. Certainly, obviously, the age-based ones as well. So it's only workers who are 21 upwards. So that would mean that, for example, workers in their first year or two of training are technically obliged to, or technically can get a lower rate. And so on. One thing as well, the thing I didn't mention, so hopefully the age thing will eliminate most of the people who are entitled to not be on the minimum wage. I think most people working for their father or their grandfather are probably under 21, and so on. People in their first year of employment are probably under 21, and so on. In addition to that, though, I have looked at the age rates, and actually most people, just an additional point, most people under 18 and 19 are actually paid the adult rate. That the people on the sub rates are pretty small according to the Labour Force survey. But anyways, I can't measure those things directly, so I basically just stuck with workers over 21 and allowed for substantial measurement error as well. So even if one thing, even if we what I emphasized there when we looked at the pictures, there's about 2% of workers who are earning less than 2/3 of the minimum wage. So that would be lower than the sub minimum wage rates. So and these are workers over 20. So even if that's feeding into it a little bit, there's a lot more going on here than people in the sub minimum wage rates being counted. So I don't think that's what's driving it.
And you touched on this, I think, after the question had come in. But just in case you want to follow up on it, is to what degree do the figures for non-compliance made up of those of undocumented workers and nationals, or those in bogus self-employment situations?
Yeah, self-employment. So is out. I can't say anything about self-employment. So this is solely for employees. So I can't say anything about that. So there could well be bogus self-employment going on that's not counted here. As far as non-nationals, I was a bit surprised by the non-nationals thing. That it's certainly showing that non-nationals from basically, as I said, the further away you go, the higher is the rate of non-compliance. But there isn't a huge difference between Irish nationals in UK, and then the next highest is people from the EU, other than Ireland and the UK, and then the highest is people from other countries. But the difference is a couple of percentage points. It's not the main driver of differences in non-compliance. When you look at, I also did it. I hadn't time to show you, but I looked within occupation groups and industry groups, and when I showed you the youth groups, the age groups, you get much higher rates of non-compliance within particular age groups or particular services, skills, occupations, and so on than you do across the nationalities category. So that doesn't seem to be the main thing.
Yeah. Okay, I'm going to leave it there. So as people have 5 minutes before the next session to grab a cuppa.
Okay.
Thanks very much to all our speakers. I'm looking at a range of different issues related to earnings in the Irish labour market. And yeah, I'll leave it there. Thanks very much. The next session starts at 11:10, and you'll have received the email with the link for that session. Thank you.